You're listening to Africa Business Radio, where you get up-to-date insights on the Africa business landscape. Log on to www.africabusinessradio.com. Your favorite shows are available on podcasts. Download them on our website and mobile app. Africa Business Radio, towards a profitable Africa.
Speaking currently is Mr. Bola Onadele, who is the CEO of the FMDQ, of course, Nigeria. He's a keynote speaker, and of course, he's speaking currently.
And the forecast already is that for the fourth consecutive year, even without COVID, the economy was going to contract. Ghana and South Africa are luckier because the price of gold has increased from March, as everyone considers gold as a safe haven during this period. The prices of other metals such as tin, zinc, and copper have also been on the decline since March. So you can think of countries like DRC and Rwanda, the situation with those countries. Let's speak to the markets very quickly, because those were devolving into a tailspin since COVID. We'll start with the equity and fixed income market in Africa. And on the back of the volatility amidst the uncertainty, the African market struggled to grasp the rapid impact of the outbreak. And this was marked with repricing, which occurred across all the asset classes. Again, with less liquid assets facing the largest price adjustments. Investors, as expected, took flight to safety, and they went towards the safest assets as their risk appetite for riskier assets disappeared. This prompted the World Federation of Exchanges to release a statement in March stating that volatility levels were comparable already to what we saw in 2008. In actual fact, there was a particular day where the losses witnessed was comparable to what was seen in 1987. Cycle breakers were encouraged to discourage disorderly markets and to allow some cooling off in the markets. The African Securities Exchange Association reported significant volatility across exchanges in Africa, and also encourage some resilience and some resilient measures to be put in place, depending on the peculiarities of the market. In South Africa, the Johannesburg Stock Exchange, the JSE, widened its circuit breaker trigger points, halting trade periods for 5 minutes at a time to still allow for continuous trading despite the high volatility. And in Nairobi, we saw the Nairobi Stock Exchange doing same, after a massive investor panic as the first case of the virus was announced in Kenya. In total, I think equity market capitalization worldwide dropped, and I think has lost about $17 trillion in just 52 days. Again, for all of us in investment management, we do appreciate the interconnectedness of the economies and the severity of this pandemic, and the rich diffusion of information at this time. I've really encouraged market jumps and very high levels of volatility. This is the new world, and social media has contributed fanning fear and misunderstanding at the onset of the pandemic, which incubated anxiety and fueled the collapse of investor confidence. Prices of risk assets fell sharply in the equity and fixed income markets, with some recovery being witnessed in the last couple of weeks. However, sentiment seemed to still be very fragile. From what I've said so far, and the situation of Africa and the movement of capital, it is expected from the previous position that there will be capital outflows. And indeed, all across Africa, we've seen unprecedented outflows in terms of size and also the speed with which they occur. In actual fact, the IMF recorded that about $40 billion of flows have left emerging economies. The prediction is that there's going to be massive decline in foreign direct inflows, and this may be between 30 and 40%. And we may see this situation getting us up to 2021. The massive sell-offs were witnessed in East Africa as foreign investors, who made up about 70% of daily trading on the Nairobi Stock Exchange, actually became net sellers of equity. The same trend was observed in Tanzania. Remittances and income from tourism are drying up fast, or we can say have dried up, with air travel grinding to almost a halt. Again, that is expected with all the travel restrictions all over the world. Tourism contributes $200 billion to Africa's economy, and remittances have contributed $82 billion. You agree with me that this is some financier of some sort to those economies. In terms of foreign exchange, let us spend some minutes to x-ray what is taking place. With the lockdown restrictions in place in most countries, demand for goods and services was vastly reduced, and widening of bid and ask spreads in FX markets where they've been trading, absence of depth in order books, and the inability across several markets to execute large transactions without a corresponding price adjustment pointed to a tightening in liquidity. Most African central banks embarked on monetary policy easing methods and chose to ease the stress in the short-term funding market by reducing banks' reserve requirements and creating lending schemes for companies, especially SMEs. I'd like to note, and I'd like to repeat that what we saw was that most central banks eased on monetary policy and actually reduced reserve requirements as expected, and they created lending schemes for private companies. There were hardly any interventions in the securities and derivatives markets, reflecting the less developed nature of Africa's financial markets. Yields have dropped, especially in Nigeria, to levels below inflation, and we're yet to record interventions in this space. Some African central banks have chosen to intervene in the FX markets. The interventions reflected that they still see this market as one that requires intervention from time to time, speaking to the emotional connection with foreign exchange markets rather than allowing the markets to assist in asset allocation. We saw South Africa adjust its repo operations and lengthen the tenor of repo operations from overnight to 3 to 6 months. Real estate, because we should ensure we touch on every sector and the asset class that some of the panelists will speak to, witnessed liquidity pressure as well, especially the commercial segment, which in this case has been intensified due to this pandemic. Lease payments, what we see is most people deferring, in some cases being unable to keep up with lease payments, especially in the hospitality and the retail subsectors, due to the slowdown in footfall predicated by the safety and health concerns. The office and industrial subsectors have also started to face challenges by changes in the way people work and changes in supply chain. What we're having today would have been all of us coming to some hotel or some office to have discussions. Near-term impacts may be offset by tax reliefs or some other government stimulus. Earlier, we had Benga speak to government stimulus, and I think a lot of African countries will still need to consider this and how to support these economies. Because apart from the tax reliefs, there have been massive dislocations and impact on jobs. I'm sure that the panelists will speak, the eminent panelists today will speak to this a lot more as well. Nigerian financial markets. Let's spend some minutes on this as well. Where we sit, the exchanges, we can report to you that the number of deals in the Nigerian treasury bills and normal bills market have declined sharply. I think between Q1 numbers and now, using the FMDQ platform as an example, we've seen a drop in turnover close to 55%. There's been little trading in the non-government sector, and in terms of statistics, all the numbers are down. The OTC FX futures, which the central bank has used as a policy tool to arrest volatility in the FX market, saw a rise in March, and the value of pickup went up. But our central bank, interestingly, increased the futures rates. There's been a drop in that sector, and hopefully, I'm sure the panelists will speak to that. A situation where the spot market at the moment is miraculously steady, and the futures, the rates for the futures are rising. Probably portend a situation where you have less hedging going on in the system, and then the central bank may have to face that sort of reaction, which could lead to further pressure on the currency. On commodities, the export commodities in Nigeria dropped as the global market demand dwindled, and stock continued to pile up. In some cases, they couldn't even leave the shores of Nigeria. The price of cocoa has fallen. The price of Bonny Light, which is a crude oil blend price, has also dropped by about $20, and has just recently rebounded to levels of about $40 per barrel. Other economies have not fared any better at this time. The equity market in Nigeria has experienced wild swings. There were profit-taking activities at the onset, and which was soon eclipsed by buyers who recognized value in the price. This corrected the stocks, some of these stocks, and April recorded the best month, quite honestly, since 2017. What has been apparent, however, is through the daily ups and downs of the stock market, the shallowness of the market is revealed by maximum price movements, even with only few trades being executed. Foreign transactions have declined from about 70 billion naira in January to about 35 billion naira. While foreign inflow into the stock market reduced from about 23 billion in January to 18 in May, outflows reached a peak of 87 billion in March and have since reduced to 16 billion in May. Year to date, the Nigerian, which is the NSE All-Share Index, has dropped by 6%. Despite this pandemic testing the resilience of the Nigerian financial markets and almost bringing them to their knees, the financial markets are still standing, and all the markets are able to operate virtually. And I think to date, since we started, we've not reported any disruption to the digital offerings of both the Nigerian Stock Exchange and the FMDQ platforms. The debt market has seen the issuance of new corporate bonds and commercial papers, especially of prime companies at this time, and is boosting fixed income activity, albeit the primary market side of it. CBN stimulus. The proposition by the central bank recently to stimulate the economy portends good news for the financial markets. from the proposed establishment of Infraco PLC, which will have an uptake of 15 trillion in terms of equity and debt capital, and for various injections into the real sector, sectors of health, manufacturing, agriculture, etc., the involvement of the capital market will definitely be essential. From SMEs having to raise equity in order to expand and to be more efficient in scale, opportunities for the government to raise domestic bonds, private sector participation in infrastructure programs and projects, the vista is actually very encouraging. Sustainability financing, securitization of assets, introduction of alternative debt instruments, derivative products, hybrid asset classes, private capital, etc., should characterize a new landscape as we embark on a new journey for after emerging from this pandemic. We've heard the central bank governors speak to taking control of our economy, taking control of our destiny, and taking control of our future. Such ambition and goals will require coordinated and structured program from government and private sector. Private capital will especially be essential as the government is coming to the realization that no true economic growth can be achieved without private sector participation. And we're talking of private companies here. Some are small, some are medium-sized, and some are large companies. This will introduce the much-needed depth in our markets and make aspirations of having a more liquid capital market able to withstand shocks become a reality. With the diversification agenda of the government hopefully becoming a reality, the need to have embarked on foreign exchange reform will be apparent, and our foreign exchange market will truly become market-driven as it ought to be. Ladies and gentlemen, now is the time for all of us to develop ingenious and innovative ways to grow and deepen our financial markets. The conditions thrust upon us have left us with no choice but to make these markets work. As regulators, market organizers, market developers, transaction partners, investors, etc., we all have a part to play, and it is my hope that we rise up to the challenges and opportunities ahead of us and ensure that we work towards building the financial markets capable of turning around the economy and the fortunes of this great country. We must always remember that capital is highly mobile. And when I speak to capital, I'm not speaking to foreign capital alone. I'm speaking to also the capital of Nigerians and Africans. Capital is highly mobile, so we need to do a lot strategically and tactically to attract it and to retain it. Thank you for the opportunity to be part of this session, and I wish you fruitful deliberations.
Thank you very much, Coco, for that. Highly insightful as expected. Many thanks for your insights. Quite a few takeaways from that, and look forward to interrogating some of those themes as we move on to the panel conversation. I know that you will be taking questions, but I just thought maybe if I can just ask one question before you leave us, so to speak. I just want to get your perspective on how you see, you mentioned something which I thought was very important. You said it's really time to develop new and ingenious ways to make the financial markets work. Now, I just wanted you to, if you like, put on the hat of capital market. You did mention that you're not a market regulator, but more of a organizer, if I want to use the term. How do you see things changing? One thing that I certainly anticipate is that, just as you mentioned at the top of your presentation, that we shouldn't begin to think Africa, Nigeria, we must indeed think global, because the concept of globalization in terms of investing is a real one. So with that in mind, I just wanted to get your thoughts about some of the trends you anticipate could come out of this pandemic moving forward. In terms of how people invest, maybe the type of securities that may be available, the options that investors may have. Just a few thoughts on that before I let you.
Thank you, Wale. And I think the panelists you have will do a better job, but I'll try, and they'll probably take them from there. When we look at markets, your markets, anywhere you have to set up your markets to attract liquidity, and that liquidity will come on the back of confidence, and confidence will come on the back of governance, structures, products, and all those things. I think Nigeria needs to very quickly appreciate the role capital will play. And as I said earlier, capital of Nigerians. Nigerians today, the world, everybody is exposed. It's technology, there are platforms, there are top practitioners, some of them on this panel, that interface with, anyone you can think of globally. So if I'm an investor in Nigeria, I'm thinking of my wealth and how to protect my capital and grow it. So the value of the foreign exchange will need to be right. The yields I get will need to be right. When I talk about the value, it's not for it to be, it's not that the currency will not depreciate and appreciate, but there are risk management tools to hedge this volatility out so decisions can be taken. Foreign direct investor will look at your country and look at the structure of your step-up depreciation. For a long period, it could be stable. And, overnight, you take a big jump up and then you run that step. So it looks like steps. That's going to be very disturbing for a foreign direct investor who is mindful of protection of capital and for that business to continue to generate. So we need to quickly think of what sort of philosophy we're going to have in Nigeria. What sort of economy do we want to have? And that would define the sort of markets and what we do with our markets. And in positioning these markets, we want them to be better than the market of a competitor. The countries are actually competing for capital, and capital is moving and looking for the best. So for me, I'm going to end by saying the first thing is the philosophy. What do we want with this economy? How do we want to run it? And the government and private sector, once we have that codified, we can then start dealing with strategy, leadership. And then once we have the philosophy, the strategy and the architecture will fall in place. And each time those of us, our regulation has to be the capital market regulator and the central bank are the big regulators in that space. They too align their regulation. For us, we look at market conduct because that is important for liquidity. I want to ensure that the players in the market, are ensuring we have a market that's got integrity. Our fixings, our indices, and all those things must be independent. And that's some conversation that I believe that Tom, Onome, Ini, and all my other colleagues will speak to. But post-pandemic, and we shouldn't wait, but Nigeria needs to reposition this, what I call the DNA of his economy and the market. We've seen some treaties coming out from the central bank. We're waiting for the SEC, but there has to be some structured, some codification. It's almost going to be like the Bible or the Quran. We have to take them that way, that you will not deviate from this. And nobody, irrespective of who you are, will deviate from this. And that's how to run it. So you can't change that philosophy once the country decides that's the philosophy. I think Nigeria needs to start, and this is an opportunity from this crisis to produce heroes from this crisis and produce a greater country.
And that was a brilliant one by Mr. Bola Onadele. Of course, giving a general overview of the current landscape and the impact of the current pandemic on the African economy. Of course, Josh, what do you make of everything that you said? He was able to touch on different asset classes and across the different segments of the market. What do you make of that keynote address?
Yeah, he painted a beautiful, realistic picture of the current situation across Africa, and of course he took right from the fall in oil price to the rise in the price of gold. Nigeria and some other oil exporting countries, Angola, in Africa, how they will suffer from the shock. And of course, good news for Ghana, because the price of gold has been on the rise.
Yeah.
And then he left then. I also looked at FDI inflows and outflows from Africa.
Which is a major concern right now.
Yeah, which is a major concern. His analysis was, look, in some markets, you've lost more than half from January to when the pandemic actually heated the system. That's March, Some countries have actually lost half of that value in Africa. It was a brilliant presentation, but at the end of the day, he also gave a ray of hope.
Which is very important, actually. For some people, you would have probably expect, that address to close on a sad note as to, okay, there is no hope, but I like the fact that, we're still able to see some light.
Yeah. He gave that hope, which is very important. And from what we know in investment, expectation is key. It's a key factor.
Very much so.
Let's look at it. The whole essence why you invest is investment is based on expectation. I'm putting my money in asset A, believing, thinking, hoping, expecting that I will make 20%, 15% return in a given time. It's based on expectation. And he has actually been able to paint Africa in a good light. Despite the challenges, this is still the place to be. And that is what we believe. That is what we have always preached on African Business Radio. Yeah. That Africa is the future. And
he touched on South Africa, and of course I would have expected him also to spend a bit of time speaking about China, and of course what the impact of the outlook of Chinese economy has been, on the African economy, especially looking at a country like South Africa. As he said, they're also very much affected, and the fact that a lot that happens in the Asian economy, of course, very much affect some African countries.
Yeah, he didn't dwell much on China in the sense that that's where the origin of the problem of the health crisis is. But then there's no point crying over split meat. It's already done. The next thing is to look for solution and way out of it, we know that whatever happened in these developed economies affect Africa. And Nigeria, South Africa, Ghana, Kenya, all across, Egypt, Tunisia, Morocco, all across. But the beauty is there's hope, and that is what we expect to hear, and that is what we believe a good analyst should always present. Yes, you don't deny the reality of the problem, but you also let people know that beyond the problem, there's always a future and a hope.
All right.
You're listening to Africa Business Radio, where you get up-to-date insights on the Africa business landscape. Log on to www.africabusinessradio.com. Your favorite shows are available on podcasts. Download them on our website and mobile app. Africa Business Radio, towards a profitable Africa.